Hi, this is Azad Ahmed, and we're going to talk about the Statement of Comprehensive Income. This is a topic in the CSC, Canadian Securities course, and also it is a topic in accounting courses and other such financial courses. So what we're talking about, in our previous video, we talked about the Statement of Financial Position, which shows the situation of the company on December 31st or on the closing date of their financial year. However, the Statement of Comprehensive Income, what we're going to be doing is we're going to see all the income from January 1st to December 31st, if of course that is their financial year or whatever the financial year is. So it'll be for the whole year, for 365 days. We're going to be looking at what type of income the company made from its assets. And so, like we mentioned before, in the statement of financial position, that we have certain assets which are of course fixed, and also we have current assets. From the current assets, which include of course the raw material and inventory, work in progress, we are going to take those and we're going to be converting into product and services, and as a result the company will get a revenue. So this revenue is the first item on the Statement of Comprehensive Income. So the revenue is basically the net sales, or that is the operating, also called operating revenue. So from the operating revenue or the net sales, we're going to minus the cost of goods sold, or it's also called the cost of sales. So the direct product cost, whatever cost it is, based on if the company has got $1 million revenue, they're going to minus from it the expenses for example, salaries of people who are working in the factory, the utilities expenses, that is the gas, water, hydro, power, electricity, etc. All the other expenses which are incurred at the factory will be all minused, and those expenses are known as cost of sales. So once we minus that, we are left with gross operating profit. So gross operating profit gives us an idea overall about how the company is doing in terms of, and this gross operating profit, later on we'll talk about the ratios. The profit as a percentage of the revenue is a very important indication, and we want to compare that with other similar companies as to how this company is operating. And from this, if the company has certain income which is not regular, if they have, for example, this is called non-operating income. For example, if they were able to sell equipment or a building at a profit, that is not regular. So that is going to be shown separately, and that is also of course added, but it does not affect the overall profit for that, for the gross operating profit. And we're going to minus other expenses, administration, amortization, director's remuneration. So then we minus other expenses which are admin cost. So this includes marketing cost, accounting, human resources, advertising. All those costs are going to come under here. So advertising, marketing, all these things are going to be which are not regularly directly product costs, but they are supporting the cost. So we're going to minus those also. Advertising, so this all is going to be minused from here, and director's remuneration, so whatever the directors also are being paid, and all the other expenses. So from there, what we're going to get is we're going to get net operating profit. So net operating profit is going to be our basic point from where we are getting our net operating. So net operating profit tells us overall how the company is doing after minusing all these expenses. So this is also known as EBIT, that is earnings before interest and taxes. So I'm going to bring it back up here. So this is also known as EBIT, earnings before income and interest and taxes. So from here, then we're going to minus the interest cost. So what is the interest cost? That is the interest that the company has to pay on its bonds or on its loans which it has got from the banks, or bonds which it issued, so it has to pay interest on those bonds. So these costs are also going to be minused from the total EBIT. And then the taxes which are due, so taxes are due to payable for the government in that year, those are also going to be minused from the total operating section. So then we're left with net earnings. So the net earnings gives us a picture about overall how much money they're left with. And from this net earnings, what they can do is they can also, now if they have a profit, then they can pay out dividends. So these dividends are basically going to be also added. So these can be two types: preferred, if they have preferred stock, or common stock. So these are paid, of course, first preferred dividends are paid out, and then the common dividends are paid out. If the company has a loss, they're going to minus it from the retained earnings, and they may not be able to pay out the dividends after paying all their expenses. So what the company is now left with is, this is now retained earnings. And this retained earnings is added up every year, and this goes into the equity portion of the company. So this figure here will be equal to, this will be going to the equity of the company. So this will be shown on the statement of financial positions also, the retained earnings. And this retained earning is a link between this statement of comprehensive income and the statement of financial position. So this is a very important figure, and of course it indicates overall the whole company, how it's being operated, based on the revenue it's getting, based on the expenses, and after paying all the interest and taxes, what is left for paying out the dividends. So this is going to be going into the equity of the company. So hopefully this makes it more clear about how the structure of this statement is arranged and how it is comprehended. Of course, there's a lot more detail about each of these items, but for this purpose, this should give you a snapshot about it. Have an excellent day. This is Azad Ahmed from Intelligent Learning and Mentoring Institute.